Hello, freaks. This is Juan Gracia, your favorite bookkeeper, and today we're going to take a look at a little bit at the basics of bookkeeping so you can get a little bit of a clue if you're doing your stuff right or wrong, and you can understand the books or reports that your bookkeepers email you at the end of the month, or just simply don't mess up your books. All right. I'm going to share my screen. We're going to take a look at my unfinished website, which please don't judge. It looks awful, yes, but I'm still rebuilding it and I haven't got to finishing it. So I just have this blog post here. This website really sucks, and I hate the way this blog post works. I have to create a blog post, a template, and then add it to the WordPress stuff, and then still some work to do on this thing. Hopefully this week I can get it done. Anyways, let's take a look at this so I don't marble around not knowing necessarily what thing to go next. And I wrote this thing very carefully so it can be our guide for today's video about bookkeeping basics. All right. So what is the purpose of accounting and bookkeeping? The purpose is to make informed financial decisions, and that's it. It's not to calculate taxes, and it's not to provide statements or comply with regulations. It's not to provide to investors. It's just to make informed financial decisions in the company. That's it. That's it. Everything else is an extra. All right. So the first thing that I want to take a look at is the chart of accounts. And this is the very first thing that you have to worry about when you are starting a new business, when you are moving your accounting from one software to another one. This is the very first thing that you're going to encounter. I'm going to adjust my camera just a little bit because it looks a little off. Okay, there we go. The chart of accounts is basically the categories, how are you going to classify each transaction, and how you classify transactions is going to affect your financial statements. That's it. The normal accepted categorizing of transactions is assets, liabilities, stockholders, capital or equity, revenue, and expenses. And they have their subcategories like assets. For example, you're going to have your bank accounts, the people who owe you money, or as we accountants call it, accounts receivable. You're going to have your inventory, computers, desk, all types of equipment, and your fixed assets, such as buildings, office space, your leases, and stuff like that. Well, no, the leases are going to be on the liability side. Now, the liabilities, the subcategories that you're usually going to see is the people who you owe money to, like suppliers, which is in accounting jargon, the accounts receivable. I mean, the accounts payable. The upcoming rent, upcoming payroll and benefits, loans, and financing. Now, I say upcoming because it's things that you haven't spent the money yet, but you know you have the obligation to do in that period of that accounting period. So liability is something that we're gonna match up or is gonna round up after we review the expenses side. All right. So equity or stockholders' capital is basically the earnings, the accumulated earnings over periods of time, and the partner's part of the cake. You know, if you have something like a partnership, if it's a corporation, it's going to be the shareholder, the stocks, right? The stocks type A, type B, however you want to do it on the big corporations. We're focusing right now to small businesses. Usually you're going to see LLCs, and it's usually the partner's equity, what you're going to find in this account. The revenue, this is going to be basically any money you make. It can be from the sale of any product or service, and it can be for the appreciation of an asset, or you sold something like a vehicle, a desk, something similar to that regard. You put to rent something that you didn't use, maybe a car, a building, part of your office space. Any type of revenue that the business gets is going to be classified here, and you're gonna have the segregation of core operating income, which is derived from your core business operations, and non-essential or income that is not related to your operations, such as the sale of equipment, a car, a laptop. If it's not just operations, you're not a seller of cars, a dealership of cars, or you don't sell computers, and it's not revenue for your core business operations. So you're gonna have segregated like that. Also, the interest, if you have a bearing interest account, bank account, you're gonna classify those in that revenue that you get from your bank in here. If you also monetize on YouTube or on Twitter, that money from that account, the monetization is going to come here. It's going to go as a sub account or subcategory. And finally, we have the expenses. And I said that this was going to round out with liabilities. And liabilities, we said it was the upcoming rent, upcoming payroll and benefits, all the things that you have the obligation to do, but you haven't paid yet. In expenses, you have the things that you have paid yet, that you already paid, that you paid in that period, like the payroll that you paid, you're gonna see benefits paid, business expenses, business trips, gasoline, software, plane tickets, any meals, any type of business expense that is strictly related to the business, like not personal expenses. Your personal expenses might sure never go into the company's expenses, but any company expense is going to be here as a subcategory or sub account, like we will call it. That is the chart of accounts. And you usually in the accounting software that you get, QuickBooks or FreshBooks, they're just gonna come with already a chart of accounts. It's gonna suggest to you that is like a template. Just accept it and take that. It's gonna require a little tweaks for just to structure it according to your company, depending on the niche that you are. But for the most part, the default chart of accounts in any accounting software, that's acceptable. Let's see, recording transactions is another of the basics of bookkeeping, because accounting and bookkeeping essentially is recording transactions, recording stuff that happens, and recording it in the proper account or category. That's pretty much accounting. The rest is just generating reports and maneuvering the numbers and the information that you already put in. But it's the most thing of accounting is just recording stuff and then recording it properly into the right account or category. That's it. So recording transactions is the heart of bookkeeping. You need to enter all financial activities like sales, purchases, expenses, and payments into your system. Accuracy is critical here, as it directly impacts your financial reports. And that, do not forget, not only in quantity, but categories, because the categories made up do something different to all of your accounting reports. So make sure you understand how to record transaction. QuickBooks, the QuickBooks, Xero, all of this is like software, accounting softwares, they already have like their tutorials, very quick, easy tutorials to follow on YouTube. So it's not really that hard to learn how to record something. And for the most part, the most common transactions that you're going to be recording is going to be recording an expense, recording an invoice for income or a bill, creating invoices for suppliers with a future due date if you give them credit. What else? Doing the bank matches and reconciliations and payroll, and that's about it. There's not that much complexity. There's not that many types of transactions. Of course, depreciation and amortization, but you can see that's a whole different animal. It's not that hard, but it's a little bit different to understand. Let's move on to the bank reconciliations. One of the most important processes too, especially when it comes to compliance. The bank reconciliation is a must-do process. It is monthly due, but depending on the size of your business, you might want to do it bi-weekly or even weekly. It involves comparing the recorded transactions in your bank statements to ensure they match. It helps catch errors, identify missing transactions, and maintain accurate records. Almost always, the balance of your bank statement, the ending balance of your bank statement, and the ending balance in your accounting software is not going to match, but that's normal. This is going to be due to transactions not cleared within the month that you already recorded, but they're not cleared on your bank account, so they're not going to show up. They're going to show up until the next month because the transaction is going to clear in the first couple of days of the next following month. Checks in transit that haven't been cashed, transfers in transit, because some transfers take 2 to 3 business days to clear, but you already recorded it in your accounting software because it already happened. It's just that it hasn't cleared in your bank account. Any mistakes done when recording or when recording transactions, such as duplicated invoices, expenses not entered into the accounting software, checks not entering into the accounting software. So these kind of things, you're going to catch them when you're doing the bank reconciliations. I like to do them weekly, so it's not that hard. That's not that much of a task at the end of the month, but you can do it on the end of the month, and it must be done every month. After adding those transactions that are missing from one statement to another one, it should match. It should add up to the same amount. So let's take a look at the financial statements, what everybody cares about, right? Financial statements are the end result of your bookkeeping efforts. The three main statements are the income statement, balance sheet, and cash flow statements. This report summarizes your financial performance and assets, liabilities, and cash flow. So let's understand this super quickly. Income statement, it's basically how much you made and how much you spent in that period of time. The balance sheet is how much assets you have and what are the liabilities and equity related to those assets. I sometimes refer to it, even though it's not entirely accurate, but for the most part is how much you could convert into money. Those are the assets. How much you already have in money because you have bank accounts and cash equivalents. How much money you have or could convert into money against how much you owe that you're going to have to pay in the future. So that's an easy way to understand the balance sheet. And the cash flow statement, I think it speaks for itself. It's just how the cash has gone in and out during the period of time and how much is left. That will be it. Financial statement analysis. To make the most out of your bookkeeping data, schedule regular reviews and analysis. They will help spot trends, identify areas of improvement, and inform decisions for the future of your business. Because the financial statements by themselves, they don't tell you that much. But once when you compare the historical data against each other, like for the previous months or for previous years, and you compare and you can see trends, upward trends or downward trends, or you can compare it as a percentage of the revenue or as a percentage of the total cost, as a percentage of net income. You can start to see a clear picture, especially when put all together. This type of comparisons of historical data and percentage of revenue and cost. You can see a very clear picture, and you can start building more sophisticated stuff like a budget and a forecast that is going to help you make more informed financial decisions, which is the core aspect about bookkeeping and accounting. The conclusion is that remember to hire a professional the moment you can afford it to make sure that you have accurate financial records, or at the very least, the person is going to be taking care of it. Make sure that they have some learning going on. It's not the most complex thing in the world, but it will require some reading and maybe some online course. So yeah, make sure that you have a person that is informed about it. Don't just have the secretary or the wife doing the books for you. Try to make the most out of it and just get a bookkeeper. You can get a very cheap one from Mexico. A lot of us know how to do this stuff. A lot of us have experience with QuickBooks. You'll be surprised how many outsourcing companies are selling Mexican bookkeepers, Mexican IT engineers, Mexican software engineers and marketers and social media and graphic designers to the US at very cheap prices. So something to consider. All right, that is it for today. I hope that you found some value in these basics about bookkeeping. You have a little bit better understanding. And yeah, hopefully you will find this information useful. That's it for today.